So I just watched a video, 2 million views, 2 million people, and the entire premise was that the housing market is about to crash in 2026. Prices plummeting, panic selling, and foreclosures everywhere. I watched the whole thing, and almost none of it is actually happening right now.
Okay, Anthony, but hold on. Those 2 million people aren't stupid. My phone has been blowing up all week. People are genuinely terrified. They're asking me, should I wait? Should I sit tight? Is a crash coming?
Yeah, Manley, that's the exact problem. 2 million people believe a story that the data actually doesn't support. And because they believe it, they're making a financial decision that's going to cost them tens of thousands of dollars.
But is it a story? Or are they just being rational and cautious, given what they've seen before?
You know what? That's actually a fair question, Manley. Let me show you something, because this is live. This is happening right now. And the answer, it might actually surprise you. Okay, so here's what everyone is actually saying. And I mean everyone. The narrative, it's locked in. Home prices are too high. Interest rates, they're stuck. There's just too much inventory. And the builders, they're offering crazy incentives. And therefore, logical conclusion, prices have to come down. A crash is coming. That story is everywhere. Reddit, YouTube, TikTok, financial news sites, your Aunt Sally. Smart people are saying it. Institutional investors, they're saying it out loud. And the conclusion people reach is simple. Just wait. Why buy now? You can buy cheaper in 6 months. That's what we're seeing.
And that's not insane logic, though, right? If prices are actually going down, does it make sense from a pure math standpoint?
I mean, that's completely fair, Manley. So let me ask you something. In the past 15 years, when was the last time we saw, like you and me as lenders, home prices actually fall? Not slow down, not appreciate less, but actually decline.
2011, 2012, after 2008, prices fell for about 2 years.
That's right. We're talking a long time ago, 14 years ago to be exact. And those 14 years, everyone who bought, even at the absolute peak in 2007, still have more equity than someone who rented and waited for the crash to happen.
Yeah, but this time it's different, though. We have builders offering massive incentives now. That has to be a signal the market's shifting, right?
Yeah, I mean, the new builders offering incentives, it's not new. It's not even close to being new. Builders offer incentives when they have inventory. But when they have inventory, existing home prices, they don't magically collapse. They just compete more. But here's what's actually happening. The crash narrative, it feels true because emotionally it's satisfying. It gives waiting a moral dimension. If you wait, you're being smart. If you buy, you're being reckless. And people, they want that to be true deep down inside, so they believe it.
Okay, but what about interest rates? That's the piece I keep coming back to. If rates do come down, wouldn't waiting actually make sense?
Okay, that's a fair question, but no. And here's why. In January, what was the universal forecast of rates? You remember what we were talking about?
Yes, I do. Rates were supposed to hit 5.8, maybe 5.5 by June.
Yeah, and it's all your fault they didn't. Not really, but by now, unanimously locked in economists, mortgage experts, institutional forecasters, they're all saying the same thing. Where are the rates?
6.49, 6.5, that's where the rates are.
It's completely wrong, and nobody's talking about it. Nobody's saying, hey, maybe our predictive models aren't reliable as we thought. They're just moving the goalposts. They'll drop the second half, they'll drop next year, but here's the uncomfortable truth. The Federal Reserve, the economists with PhDs, the institutional money managers with billions of dollars, nobody has the ability to predict where mortgage rates are going with any accuracy beyond a few weeks. And if they tell you, they're freaking lying.
So, you're saying just ignore the rates? Just ignore the possibility they might drop?
No, not at all. What I am saying is every month you wait for rates to drop, aka timing the market, is a month you're paying rent. Rent that goes up while waiting for a rate that might drop. And you can actually refinance if rates do drop, which they should. You cannot get back the equity you didn't build while you were waiting. You're going to look like the idiot that thought you were the smartest person in the room. Come to find out, you were the last person to enter it.
What are you?
An idiot sandwich.
Let me challenge this from a different angle, because I don't think people are stupid. I don't think they're waiting because they watched a YouTube video. I think it's because they genuinely can't afford to buy right now. The entry price is too high, their income hasn't kept up, and they're looking at this market thinking, reasonably, I can't afford this. Maybe I can wait if prices come down, and then I can afford it. That's not crazy.
Yeah, that's totally fair, Manley. I mean, that's actually the real issue we're seeing. We're in the trenches day in and day out, and we're talking to these families, and they're saying the exact thing that you just stated.
No, really, because affordability is bad right now, worse than it's been in decades. So isn't the crash narrative partly rooted in reality?
I mean, kind of, but kind of not. The median home price in US, it's about $430,000. That's 5.8 times more than the average household income.
Well, yeah, that's high.
Yeah, in the 1950s, that ratio was 2.5 times. 1980s, 3 times. The 2000s, little over 3.2 times. The peak is in 2006 at 4.2 times more. We are higher than 2006. We are officially the highest price to income ratio in modern American history.
Whoa, let that sink in. So prices are too high, right? They have to come down at some point.
Well, high doesn't mean they're coming down, not by any means. High means they're doing what they're supposed to do in an inflationary market. They're just adjusting upwards.
But inflation is cooled. The Fed isn't cutting rates yet. So maybe that upward pressure's gone?
I mean, that's facts. You're stating things that we're seeing on a daily basis, but inflation cooling and inflation reversing, those are two completely different things. Inflation cooling means prices are still going up, just slower. Inflation reversing, that would mean prices go down, and that only happens in a deflation environment, which happens in recessions. And here's the part no one talks about. If prices are high because inflation, they're not coming down. They're staying high or going higher because inflation doesn't reverse, it compounds. A dollar in 2026 is worth less than a dollar in 2025. So a home that costs $430,000 in 2026, guess what? It's going to cost more in 2027. Not because the market is overheating, it's because the currency is losing value. This is by design.
So you're saying prices will go up, not down?
I mean, in a sustained inflationary environment, 100% Manley, nominal prices will almost certainly go up. The question is not whether prices drop. The question is, do they go up slowly, fast, or stay flat? But come down significantly? That isn't one of the realistic scenarios.
Okay, but surely at some point, affordability becomes so bad that demand breaks. And when demand breaks, prices have to fall, correct?
So demand, it does break, but what does that mean? It means people stop buying, right? Because they can't afford it. Builders, they're going to compete harder. The prices will stabilize, but stabilize is not a crash. It means fewer transactions, higher prices, equilibrium.
So the people who couldn't afford it before still can't afford it.
Exactly. You nailed it. The market just sits there. Fewer sales, same prices. That's not a crash narrative. That's a slowdown narrative. The crash is not coming.
And for a real crash, you need panic selling, correct?
Dude, that's facts. You need panic selling, which requires a financial crisis, foreclosures, credit markets freezing, job losses. None of that is happening right now.
Yeah, but unemployment's still low, Anthony.
It is low. I will say that with this all AI, but the foreclosure rates, they're historically low as well. Homeowners have record equity. They are literally swimming in it like that money vault with Scrooge McDuck. So for prices to crash, one of those things has to break, and none of them are breaking. All right, so here's what I think is the real thing we need to talk about. Because I agree with you, Manley. People aren't making decisions purely on reason. They're just not. They're making them on emotion. And the emotion right now is fear. There's fear and uncertainty. And I get it. Because if you're sitting on the sidelines and you're terrified, you're going to buy at the peak. And then 6 months later, when prices drop, that's the real fear. That has happened to people, and we've seen it in the past history. But let me show you what exactly happens to the people who wait. You're 32 years old. You need housing. You can afford a $400,000 house and a mortgage right now at, say, 6.5%. Your payment is $2,500 to $2,800 a month, taxes and insurance included. You could buy that home today, or you could wait.
And in your mind, you're waiting for either a price drop or a rate drop.
Yeah, that's exactly right. So let's say one of those happens, right? What you just said. Let's say prices fall 10%. That home is now worth $360,000. You're excited. You finally get to buy. But here's what you're not calculating. In the year you waited, you paid rent, $2,200 a month. That's $26,400 for the year. That money is gone. Bye-bye. It's not equity. You don't get it back. Meanwhile, the person who bought, even if the prices dropped by 10%, guess what? They paid down their principal. They built equity. And they're locked in a payment that doesn't change while your rent, it went up.
Yeah, but what if rates also dropped? That changes the math, right?
I mean, that's what people are trying to time the market, right? Rates, if they did drop slightly from, say, 6.6 to 6.4, let's say they drop another 100 basis points, which would be huge. They hit 5.5. That's meaningful. On a $360,000 mortgage, your payment drops from about $2,040 to $1,824. That's about $200 a month. That's good. That's real. But you still paid $26,400 in rent that you don't have to pay. And the person who bought 6.5, they can refinance into that 5.5. So who's the smart one here? And who's still ahead of you?
What if prices don't drop and rates don't drop? What if you wait and nothing happens?
Yeah, I mean, here we go, timing the market again that we see day in and day out with clients. That's exactly and actually the most likely scenario that we're going to see play out. And if that happens, you've waited a year, paid a year of rent, and now you're buying the same house that costs more because of inflation. You're now worse off. Congratulations. But here's the thing nobody's talking about. It's not just about the payment, it's about the optionality. If you own a home, you have options. You can refinance when rates drop. You can sell if you need to move. You have equity you can borrow against, like Scrooge McDuck jumping in that vat of money. Your payment, guess what? It's locked in. You have control as a homeowner. But if you're renting and you're waiting, quote, timing the market, you have no options. Your only option is to wait. And waiting is the single biggest thing that actively costs you money in rent, in equity that you don't build, and appreciation you don't capture.
So the people who are going to look back at this moment and regret their decisions are the people who waited?
100%. And in about 2 years, when they finally realize waiting didn't save them any money, it actually cost them money, by then, someone else owns the home that they wanted. Well, guess what they're doing? Sitting on a rent payment that doesn't build wealth.
Where's my money?
Okay, Manley. So we've talked about housing, but you can't talk about home prices without the broader economic picture here, because the economy, it's the heartbeat. The Federal Reserve just held rates steady for the fourth straight meeting. Fed's fund rate, That's 3.5 to 3.75%. But here's what's interesting. The Fed signaled the rate hikes might be coming, not rate cuts, dude.
Why would rates go up?
That's what everyone's saying, right? And it's easy. Because inflation, it hasn't completely cooled. And the economy, it's showing resilience even with rates elevated. Right now, the economy, it's sending mixed signals. The job market, it is softening. We all agree on that. I mean, we lost 966,000 job openings last year alone. That is real. Credit card delinquencies, they unfortunately are up. That is a warning signal. But unemployment, it's still low. Layoffs, they haven't spiked, and home equity is still at record levels.
So, you're saying the Fed is staying put?
I mean, that's exactly what the data is showing, Manley. The Fed is staying put, and it's saying, hey, we're watching this, and we're not really sure where this goes. Mortgage rates, they move on the 10-year Treasury yield, not on the Fed funds rate. The 10-year is at a 4.48%. That Treasury yield has been volatile. One week it's up because of geopolitical tension. The next week it's down because inflation data came in cooler. The bottom line here is this. Rates are unstable. They could go up if recession fears fade, and they could go down if recession fears spike. But they're not dropping dramatically anytime soon. They're not spiking dramatically either.
So, the environment is uncertain but stable?
So, I mean, the environment we can say is uncertain, but it's stable, which actually means mortgage rates are probably in the range we could live with for the next 12 months. Not the best rates in history, but they're not the worst either. But certainty, that's a luxury in 2026.
I think I can live with it.
All right, here's what this all means. You're sitting on the sidelines right now because you're convinced a crash is coming. You've built that story in your mind until it feels like absolute fact. You're waiting for rates to drop. You're waiting for prices to fall. You're waiting for certainty that will never come. And while you're waiting, two things are happening simultaneously. One, someone else is buying the home you wanted. They're building equity. They're locking in a payment. They're making a decision. Number two, you're paying rent every single month, rent that goes up, and equity that you don't build. The crash, the narrative feels smart. It feels like you're being strategic, being careful, being rational. But the data doesn't support that at all. The fundamentals don't support it. And the math, it doesn't support it either. The people who are going to win in this market are not the ones waiting for perfect conditions. They're the ones who understand that perfect conditions never come. They're the ones that accept today's reality and build on it anyway.
Yeah, Manley, I mean, you are speaking facts right now. And here's what our viewers need to do this week. You need to call your lender. You need to get pre-approved, not to buy tomorrow, but to understand your actual buying power and options. Because the moment you see your approval letter, that's when everything changes. You stop being a renter who hopes and you become a buyer who acts. We're Anthony and Manley, and this is the Mortgage 101 podcast. If this hit differently, like it, subscribe, and share it with the one person who's still waiting for a crash that isn't coming. We'll see you next week.
Girl from the heart of Wisconsin to the waves of Hawaii. Manley and Anthony keep it real, not salesy. Breaking down rates and the truth you need to know with a little soul and a little homegrown flow. It's the Mortgage 101 podcast where real talk meets home at last. Manley's got that Midwest soul. Anthony brings that island roll when the market swings and you don't go fast. Tune in, the Mortgage 101.